Alright guys, we're going to do a study case today about a distinction within my current reactional trading playstyle, such as you see here. I'll do a quick overview over what is important to know for doing this study case as the example of my game plan, and I will give a bit of an explanation about how to do a study case and what is important on really collecting data and doing the study case itself. So we'll start out with the reactional playstyle, which is the essence and the most core component of how I trade. So in here we have a example of trading reactional. And trading reactional simply means having a liquidity or current price action that looks like it might be reversing. So in this instance, I always mark out levels that I think may react, and reacting simply means having a reversal of the approach how price comes to the level. So that's essentially reactional playing, but in this example I only trade these price behaviors and fractals, which I will be explaining a bit more in depth, but essentially I always take a reaction of a liquidity level that is formed under some circumstances. So if we'll go to the next one in this Discord, you'll see a bit explained about high and low liquidity states. In this instance, a high liquidity state is a zone in price where price is fair and price bumps around the same price levels, which essentially could be seen as a range, but is not differentiated as a range only, as it can happen in up moving or down moving price action as well. So in this instance, it's simply a high liquidity state filling orders on both sides, whereas the market is efficient, as some may call it, and price fills up both ends of the order book and stays at the same price. In a low liquidity state, we're doing the exact opposite. We're looking for new prices, or we're surging from another price, as price is in a low liquidity state and price is filling up orders for most part and for most strength on one side of the order book, so either buying or selling. And this essentially means how liquid price at a certain point and period is, and this makes it able to distinct different behaviors of how price moves at the time to detect where the edge and the creation of my setup is, essentially. So in this example we have some descending, some sideways and some ascending high liquidity states, where price may have some very tiny inefficiencies, but that's why I don't view it from an inefficiency or an efficiency. I just look at how order flow happened at that time to distinct how price behaved, instead of saying, okay, here's an inefficiency, so this little inefficiency is important to me. No, that's not the case. So here are some more examples around these ascending pieces of price action, the sideways pieces of price action, and the descending pieces of high liquidity state price action. And this is the examples for the low liquidity state pushes, as well as these. So it's simply just a clear push up or down with highly concentrated bodies and little to no wicks. And I gave this example as a random view of price action to show where high and low liquidity states happened, as we have quite clear low liquidity state down here as well as here, but some high liquidity states right here. As you can see, we have one gap, but this gap isn't important to me, as we behaved as an overall high liquidity state over time. We have a little low liquidity state right here that touches the start of the low liquidity state right here. That tells me a lot about how price might react from this level on, but I will show that in the next example. From here also on, some high liquidity state, a small low liquidity state, but I don't mind that as it's in a overall high liquidity state environment, and that keeps on as it's consistently filling the orders and having tight price action until we have a small low liquidity state right here of 2 candles that essentially goes into a high liquidity state, low liquidity state, high liquidity state. So we're essentially differentiating different periods and pieces of price action as a high liquid area or low liquid area. And it's quite visible as big bodies and as well as big spread candles show a low liquid state and tight candles show a high liquid state. So this brings us to being able to understand the total of a setup which I trade. Essentially, this is a high liquidity state, a liquidity pocket, an inventory surge, and inventory fractal. This inventory fractal is what creates the level and let me able to makes it able for me to place a level and expect a reaction from there. So it all starts with the liquidity pocket, which is also always a high liquidity state zone and period. So it's essentially two candles that are quite tight, followed by a inventory surge, which is a low liquidity state. And that's exactly why I first started with the high and the low liquidity states and explained those parts of price instead of jumping around saying, oh, right, this is a liquidity pocket and an inventory surge, as it might differ in size, and a small inefficiency in price could be seen as an inventory surge, but probably isn't. And that's what makes the edge from seeing price from an order flow perspective rather than inefficient and efficient. So right here, the liquidity pocket is a high liquidity state followed by a low liquidity state inventory surge, which makes the inventory fractal. This inventory fractal makes it able to mark the inventory liquidity, and the inventory liquidity is concentrated at the start of the inventory move, which means the beginning of the low liquidity state's inventory surge after price has formed a high liquidity state liquidity pocket. The first candle that opens the inventory surge marks the level where the liquidity is concentrated. So in these examples of a long and a short, we'll see that the opening of the first low liquidity state candle provides us the level at which liquidity is left as inventory as price switches from a high liquidity state to a low liquidity state. Essentially, this is the fractal in itself. Price moves at a fair value, not per se as I call it fair value, but price moves in a high liquidity state as it's consistently filling up orders on both sides, and it expands quite sharply and impulsive, which means that the orders that were built up there and the fair value that was there is left behind with orders that people want to get in or either place their stop at what they think is a fair value that price should not come to or should not be visiting at that time. So that's essentially the entry and the fundament of the whole inventory principle. If you use this and go back to the first example we had, the liquidity pocket and the low liquidity state inventory surge are quite clear in this example. We have some more components to the swings. In this example, I won't explain, but you can see here that there's also a high liquidity state at the top of a probable swing, as price could always continue from this point on to make a rally-based rally. So it's never defined to know if price will visit the level, but I don't have to know because I only play it when it does visit my level and approach my level. But this right here also shows a significant that if this high liquidity state is broken, right here, price has a quite high significance of coming back towards the liquidity pocket and giving a reaction from there on. So I'll give you a bit of some more examples, like right here, the origin. The swing is made up from 4 different parts, 5 with the reaction. So it's here, the origin of the swing is the start of the swing. We'll have the mid swing, so everything that is in the low liquid states or either a small level that's formed as a a liquidity pocket right here that might react, but that is able to differentiate by calling it a mid swing or a origin setup. So where the pocket really has created the setup. So like I said here, the apex that can be broken to approach level, well, the approach right here, that will create a setup and a possibility to get an entry right here for the reaction. So you're essentially playing this whole swing with the origin, the mid swing, the apex at its top, the approach back to the level, and the reaction. This is essentially what I'm trading and looking for. So what I did here is surrounding my edge, I always trade the 5 second, the 10 seconds, and the 15 seconds. And these time frames are quite low, but I choose to trade these time frames as there are a lot of criteria and validations slash invalidations that need to be correct to trade a setup. So there are a lot of price swings, but almost 4 out of 5 are invalid to me. And if I would look at every single swing happening in price, I think 9 out of 10 would be invalid to trade, and one single setup of that would be able to trade. So it's essentially a very great concept to view it from price swings, but just like in every other strategy or concept, it's time frame relative. So it means the fractal behavior behind it shows that it's formable in every time frame, but not every time frame has its power at a certain time. So if I'll go back, if I view the 5 seconds, the 10 and the 15 seconds around midnight, around the Asian session, price is quite illiquid, and you cannot see it from the start as well. Here we have the indices open at 3:30 p.m. for us in Dutch time. That's the market open at 9:30 in the USA. And at this time, price before is quite illiquid, as you can see from the candles that show here and the gaps that form, and it's quite some weird price action. And once price really opens at the half mark, we really start with a low liquidity state with a high liquidity state buildup before we open. So this essentially is the first level of the session. How I do this, I have a Notion template, which I also will be sharing in the description down below. And in here, it does look a bit different for me as I work with multiple people. But for me, it's able to I'm able to have created a system that lets me log samples and use tags, which I call distinctions and divided distinctions, to be able to mark things I see within price, to give that data, as in the sample itself, a tag, so that after I test a session as a day or a week or a month, I can give those tags and I can look back and select the tag to see all the samples that have that certain tag. So I'm able to really distinct out on the numbers of trades that have the probability of winning against losing or having no significance at all, just to skip them. So it's important to know that study cases simply are built up by samples, and samples are simply a piece of price action which is able to distinct and give tags to. You could see trades you take as data as well. That's perfect, but there are also a lot of setups you might not take, which you will never take if you don't check out the data without having a bias on it. So backtesting is very nice, but I would always advise to collect data around it and note your significances and note how to work out something. Note what you see, your observations, things you might think are true, but you don't know yet as you don't have figured out any data or checked any data. So that's what I call an hypothesis. And an hypothesis is a situation that might be true, but you can already give it details or say, like, if I manage my trade in a certain way, this will give a better expectancy, but it might not be true. And that's why you have to prove it with the data and the samples you have. And once it's done and you have some significances, as I call it, you see that the numbers really play out better and the expectancy is better, or the way of playing it makes it easier for you to execute, you can turn it into a significance. And once it's a significance, you're able to reverse engineer that significance back into something that is actionable for your plan. So you're able to execute on a consistent basis and is realistic to execute for you. This is nice as it really tells and shows us that there are a lot of things we might improve over time, as well as filter out bad stuff to not make those mistakes again, or be aware of it that once you make that mistake, you're aware that you shouldn't be making that mistake and you can back off and really reflect on it back instead of making that mistake over and over again. I will give you guys a quick example of how a study case might look. So in this example, we'll have a study case about trade management. And trade management literally means managing my trades on the lower end. So in many examples, I won't adjust my profit target. I always adjust my stop loss. And I previously did in some examples, but in most cases, let's say 14 out of 15 trades, I didn't have to move any orders at all. So viewing this is the trade management study case, and this study case is focused on this observation. There seems to be an edge in managing trades below depth after price reacts. So that simply means that after price starts to react, so hits the pocket itself, and price is reacting towards the target, I'm able to move my stop loss after it shows to react. So let's say, for example, a hypothesis could be that after it's reacted for 50% of what I'm looking for in the position, I can move my stop under depth. And depth simply means that where the liquidity pocket is, price searches towards and hits the level. In reacting, the depth means that how deep price got into the level and reacted from there. So I never manage at break even, as that wouldn't be logical, and I think it would give me a negative edge, and it showed that it gives me a negative edge, as sometimes price might just come back to where price reacted and be held, and a lot of volume comes in to hold this level. So in many cases break even would be hit, but the depth would not be hit. And as it's a very tiny bit extra more in most cases, I'm able to really get that risk out and where it has probability not to be risking more in the trade. So it makes it able to diminish a bit of losses or risk on a trade that gives this reaction like. So what I do with the study case is I mark down the hypothesis. So in this instance, if the candle of hit engulfs, manage under depth. So that would simply mean, in the example we have right here, that price shows us that price has hit on this candle, this white candle right here, as it hits the level, and this will be the open and this will be the outer end of the candle. So once price engulfs this and closes or even comes below, that is a distinction on its own. So I'm able to check if it clearly needs to break or that it simply needs to break the low or hit below the low in this instance of this candle. So after this has done, I could have managed my stop to move it under depth right here after this candle right here. So that is an example of an hypothesis I had about the trade management study case. In this instance, I mentioned this earlier on, if price reacts half, it can be managed under depth. So that simply means in this instance that if it reacts for half the position to the take profit I seek, I will move my stop under depth. So the under depth is quite non-negotiable and I don't want to adjust anything on that. And as for example, within the trade, I could trill my stop, but I won't, as I want to let it play out the highest probability and make it easy for me to execute. As I have to execute on a 5 second time frame, price comes along very fast. I have to be focused and willing to be invested in price at that time and handle it. So if I have a lot of room for making mistakes, it could have impact on the way I'm able to execute. So I rather have a high alignment rate that I'm able to execute the trades according to the game plan and according to how I should execute, rather than trying to manage all my risk every time and manage my positions each time, as I just want to keep it simple with getting the limit order before price hits level, getting into position with ATM orders, meaning that my stop and my take profit will be placed automatically, and then just letting play out the trade. And this could have some impact, as in managing under depth if price had hit certain criteria, but it must be worth it for me to manage and take these actions and have a positive expectancy return and improvement on this to be able to use it, as it would be a waste of time, effort, and thoughts to do things that won't benefit my total edge and expectancy. Now, I have checked out one significance already, and that's the significance that after price reacts, that's what it's built on, there seems to be an edge in managing trades below depth after price reacts. And here I have the significance that after price reacts, it has a great chance to fail if the depth is hit. So that means that if this depth is hit right here and price returns back and not hitting the TP, there is quite a big chance compared to not having this not having this situation, that price goes to the stop loss instead of still returning to the upside. So we're now able to view after price reacts, it has great chance to fail if the depth is hit. I've made distinctions beforehand and use these distinctions to mark out some levels. So as you can see, I checked about 80 samples, meaning 80 pieces of price that look like this setup right here. And as you can see, there were 2 samples where price has got to depth and stopped out on the depth, in this case right here, and 1 afterwards. In 14 examples of these 80 pieces of price, there was a stop out and an instant loss afterwards. So with this, I can go deeper into it. Oh yeah, and these are the direct wins, so where price directly won and didn't come back, and 28 samples of where price instantly failed right there. So in this example, we are able to focus on, okay, what if we got out earlier on the losses when managing under the stop, under the depth, and what would the 2 wins reward in itself, and compare the R against each other. So if we can match up half an R on each trade here, that would mean 7 R saved and not lost. But in this example, if we would have 2 trades that went to 5 R, we would have 10 R at the end. But we could have less losses. So we have to balance out the mental and emotional weight of executing this against the real expectancy of these behaviors. And to find out the depth stop out win and loss, I have to collect more examples for it to be convincing. As I can show you in this example, for example, the loss, I can mark out the distinctions table. I can say I want to see the direct losses. Sorry, that is not what I meant. I can see the losses that depth out of stop. I don't want to see those. And I can open this up to check how much I could have saved on these examples. But before I will go and do that, I want to collect some more samples of this week on the chart to collect and show you how to collect samples. But we will go over these samples right now. So in this example, we would have gotten in here at this right here. We would have been stopped under that, which would probably have saved us more than half a position, as we would have positioned in this way. And this can be a bit vague, but that's why I will explain it for the first time. This is the place where I would put my stop. Right here under the pockets. This right here is the entry. So we'll gotten in right here, as I always move my entry up one tick, which would have had hit this, meaning that price would go need to this as it is my stop. So really essentially the end of the pocket is my stop, the start of the inventory surge is the entry, and the end of the whole momentum thing that happens right here as price surges higher, comes back, then goes higher. This is the momentum stop, which means that this essentially is the move and the extension I'm looking forward to when price hits. So price does not hit the level, it does not engulf the candle that hits it, but that's logical as it's quite big. So in this instance, if we would have viewed it from a 50%, so meaning that the 50% would be around here. So around here we would have managed, that means that we stopped out right here and could have saved almost, yeah, I think in this instance, about 4/5 of the risk we would have taken on this trade. So meaning we would save 0.8 R. And in that example, I can stack up these R's and these numbers of how much I could have saved. Doing that the opposite side on the wins and checking out how much they would have provided, I can figure out whether it's worth it to do on the data. For the mental part, I just simply want to check out how the samples look, how price behaves, how the overall behavior creates a significance, which I'm able to see and eventually trust, being able to execute it with the most alignment there is. So in this example, I would have saved quite some bit. And we can go another sample further. This is an invalid sample to me as it shows the week first release candle, which is invalid to me. And in this instance right here, we would have saved about, let's see, here we would have saved, as I put my stop under the pocket, right here, I would have gone in right here and I would have had my TP right here, as we have back right here, this part, so which did not tap. The 50% level did get hit, as this is the total extension, this is the 50% level of it, the equilibrium, this is the candle of hit, this does get engulfed but comes back immediately. After price hits, goes here, the 50% is hit and price really reacts. I can move my stop under here, which would result in 0.5 R saved in the example where price did hit the level and the stop right here. So that's 0.5 R extra saved on this trade. So I showed two examples right here. I will be going through more right here. This is where if we choose the lower level, we have the not the 50%, as this would have extended way further. But let's say for in this example, price did reach higher, we could have saved another half R, I think. Let me see. So right here would be the stop placement, and the stop placement right here showed us a save of a total of, I think, quite a lot. I think 4 out of 5th, so about 80% risk less on the trade. That's quite big. So you can see it can stack up a lot. I'll go through the wins that happened. I'll use the same thing here. I'll filter out the distinction of the depth stop out win. Click it right here and we'll see two examples, which it already shows here. And these examples, it did show quite some R that reacted, but in this instance again, our stub would be placed somewhere above the pocket, or in this instance I would look at a stop placement right here or right here, but let's say for the sake of it right here, stop placement here, the target would be here, and in this example the engulfing candle did get hit. The 50% extension also got hit, price immediately came back, tapped it again, and then ran on towards the TP. So in this instance, we would have been stopped out at about, let's say, 20% risk. So we would have had lost 20% on the trade instead of 100% if it would have taken out the stop. But it rewarded about, let's see, in this example, about, let's say, 2.5, 3R. From here to here is 1, from there to there is 2.5, I think, about that. So that would give us 2.5R already back. So with that, we're able to compare it to the previous samples of the losses, as well as the next one. That's this sample. And as you can see, this was a bit of an unclear level that happened pretty late. So as you can see in this example, which I mentioned earlier on, price becomes quite illiquid and gappy like this, which does not show the best levels or the most valid levels, and it's even outside of the time I trade. So showing this, it's already a less valid sample. But in this instance, we would have a target right here, just like so. The target would have been here, as this is the first stop back. The stop would have been placed right here, and we entered the position right here or right here. That depends on if this is a tick, and I do think we would have been in right here. What is the middle of this? Yeah, I think it's around here. Maybe price just did not hit the equilibrium, the middle of the area right here. So in this example, you can see that the middle area of this all did get hit. Price came above this again right here, and once again here, and then price went on to hit it to take profit. But these are the ways and the possibilities to divide entries and really see how it could show a significance to you and actually play it. So you really have backed up data and evidence why you play in a certain way. So this is really something I encourage everyone to do if you're really serious about trading, because in this instance, literally everyone could tell you you're wrong, but you have the data to show for that it's right. And as I don't believe in following everybody's advice on what you should do, and more shift your focus towards providing evidence and data for yourself, so you know you can execute it, you trust it, and you know it brings a positive edge. So there is less mental friction in executing the setup, instead of believing others, YouTubers or other sources that tell you how you should trade, instead of figuring out for yourself. Alright, so now the most, from what I view and my perspective, brain dead work, as it should not be fun to do. It should be boring. As if you have a lot of emotions with backtesting or collecting data, you will probably be biased towards getting some samples and avoiding others to create a false set of data and numbers and statistics. So it's important to take every setup within your plan or that looks like your plan, so you're able to really collect every sample that you would view on chart as well. So in this example we had the first entry right here that looks exactly like the trade management study case, the swing right here, but then to the downside as it's a short position. So what I'll do with this, I'll simply use the Ctrl Shift S function of TradingView to make a screenshot of it. Then I'll have the data log spot on the left screen, but for now I will use it on my main screen so you guys can see it. I'll dump in the image using Ctrl V. Now it's in here, Notion will hold on to it, and the sample will be here forever. I can say what it is, so I can define the outcome. In this example, it's quite clear, it's a win. I have a bit more distinction around it that I won't be explaining, but what I see in here, I can see that there is a somewhat different behavior inside of this, which mixes with my most used behavior, but can bring a lot of doubt. So I always tag these out to study these even more. I see another thing that's a deep test. Won't be explaining that as well as it's bound to the balancing swing, but here we have the simple example. What I see right here, it's just a good example. It's just a good high liquidity state pocket with a low liquidity state inventory surge where price goes on to form the swing. Not the clearest apex, but price comes back and it's quite nicely comes back into the level it approaches, and it reacts not in an instant but in a decent way. All this, just what I said, doesn't even matter. I just want to focus on if it's a setup, and if it's a setup, I will put it in my database so I can use it as evidence or to check to find significance or mark out different things. Even distinctions or things I might not know, see, or use at this moment could be bound to it later on. So I'd simply go over all these examples that happened within price within my playstyle, so meaning the 5, 10, and 15 seconds time frame during the New York session where the volatility is the highest on the Nasdaq pair, and I can always look back upon these samples to figure things out from even a year back. So I can really go over a lot of data to prove myself this does work indeed. There are times where it doesn't, but even in these examples, if there are weeks where the probability is quite high and the edge plays out quite nicely, and there are weeks where it's quite boring, I might check those back and see, hey, well, Forex Factory, the news calendar, showed that this week had a lot of important events, or the elections were going on and the volatility was quite high. That was quite nicely for me, but after 2 weeks of the election, volatility calmed down a bit and I had less entries. So I thought by myself, okay, I could say that high volatile times and highly anticipated times show more liquidity in the market. And as my strategy is based on liquidity and liquidity states, and the clearer or the stronger the liquidity is, it shows more significance to play out in that matter. And that's very interesting to do, looking back on the samples, not knowing that in this example of price might be a lot of distinctions or factors that could show me significances later on. And mind, please, significance, distinctions, technical analysis, indicators, patterns are very important, but they won't guarantee success. I literally do this to improve my game plan that I made on my own and built on my own from the past years, to develop it further, to make it easier and get expectancy higher while trading less time and using less of my time to spend on trading, as I have to perform and be relentless when I'm on the chart. So I simply can't be on the chart for 12 hours. So back to the samples again. I log the sample. What can I see from this? I also have something I'm noting now, and that's the first half hour of the session has a lower probability in the past 3 weeks of my trades. I looked that back on my trades itself, so now I will be using that as a distinction to say, okay, this setup is within the first plus minus 30 minutes after the open. So I noted this. In this example isn't a lot about to note anymore, as I always check afterwards, but I can check it now, that price did win instantly. So in this example, price did hit it. It did not go to the engulfing. It did not hit the half. We just got through it and we reacted after getting a bit deeper in this example. So interestingly, I would have noted this as a direct win, and we have, so I can go back to the charts, and what I do to focus on a trend study case, I always zoom out a bit to show how price behaved beforehand and what the structure and the overall pressure were beforehand. So in this, I will go back here, I will Ctrl V it in again, and then we have a sample collected. So I can do this with more samples, I can get this back. Something we see here is a liquidity pocket again. Here, a level, and something that also mixes again with the balancing swing is right here. What we can see is that price has not taken out this low yet while we were downtrending. So the probability is lower of reacting if we did not take out this low in the downtrend we had. So we'll see what price does. Price seems to come back instantly, and mind, I don't even care what the price will do at this point. I can simply just skip, keep skipping until price has hit the level and check in the meantime if there are new levels created, which it did not, as it's all high liquidity state price action with a bit of a low liquidity state and high liquidity state price action again. So in this instance, I will be waiting for the level to be hit. As I'm just explaining it to you guys now, I will be doing it slower, but in most cases I will just tab out, get the screenshot, mark the distinctions, note what I have to note, and go to the next example to have a week of backtesting done within 2 hours or less. So in this example we did take out or did sweep the previous structure point, as I call it, and we're coming back higher. So now we have hit the first level. I'll always note both levels. And in this example, you can see price swept here. We got higher, we broke it, and we did not react. Something interesting on this is also a study case and something in distinction I'll be checking if price forms a new level while reacting on the first level right here. So in this instance we can mark out quite a bit. As I said, it also has a bit of a behavior in it from the balancing swing, which I'll be noting again. What you can see also is the distinction I just told about reacting from another level. So react pocket reaction of another level. So this pocket is a pocket that's created from a reaction of another level. So I will be noting this down. What I can see as well is the structure point, the SP, did get swept, and it was a fast sweep, it wasn't a long sweep. So I will be marking that as well. It was pro-trend situation. Something I do not note, I only note it when it's counter trend. So when it's rangy or when it's pro-trend, I don't mark those. I can always look those back if I want to, as I always take a screenshot of the bigger environment. So what we did right now is get 2 samples, mark some notes, and as you can see, sometimes I might miss some distinctions which I noted earlier on. I'm still a human, I will make mistakes, but I will always check the data back. So I will be noting the distinctions which I think of when I see it, but I will go back over these samples one by one to note everything that I have to note for the study cases that are priority at this moment for me. So something I got myself lacking at right now is not marking the first 30 minutes after the open, as this setup has formed 5 minutes, or let's say 2 minutes after open and hit 7 minutes after open. So I'll have to mark these things out right when I'm doing it, but I will also check those back after I'm done with collecting the data. So I'm sure that the data I collect is used at maximal potential. So we collected this data and marked this out. In the meantime, there was a level that got formed right here, and this level shows quite nicely, but reminder, it is counter trend to the whole push downs we had from this midday and from the the early New York session was down, and the session also reacted quite strongly down. We did not react at this level, but there is a pocket right here. If we would view it from the 15 seconds, there is a low liquidity down here. I don't like it, but there is a pocket right here. So it might react from there, or it might boost further on. If it boosts further on, it shows more strength to me. But this level gets less relative as further away it goes. So I'll be waiting for this. Just waiting. And we can see that we did push above this, but we did not held higher, and we broke the apex right here lower. So right here we tested the apex down. That's why I reminded you beforehand, it's a counter trend level, and I don't trade counter trend levels because they just have a low probability of working out. But I will be using this in my sample space as well, as there are some things I might be checking out on the counter trade trades. So in this instance as well, it's also in the first 30 minutes after the open. Is there something interesting? Yes, as I have to zoom out a bit and put it in here again, as well as that I do like a screenshot of a somewhat higher time frame, as this shows it's quite a weak first release candle. That's also visible in the Discord. And in the Discord I have some studies active here, which is, for example, the first week inventory. So if we have a weak first candle that releases in a low liquidity state, that is a lower probability of reacting. So this stacks up the evidence again. And as you can see on the example right here, so I've noted the 15S with it, so we'll marking here, as well as the 10S, as I want to get a screenshot of that right here. In this way, you can see that it's quite low probable if we take these things into consideration, meaning counter trend and a weaker first release candle, as this is somewhat weaker, but as we go on the 5-second time frame, these two candles are almost the same size combined as this last candle, and we want this last candle to be the first candle to really be impulsive in a low liquidity state. Something interesting that came up after this sample is I noted, or I deleted, but on 15 seconds I noticed this level right here. That is pro trend, but we still have the structure point that I want to be taken out right here for it to be called valid. But once again, we're not trading right now, we're just collecting data. So I'll be marking this here. And as you can see, we come back instantly. We haven't taken out the structure point yet. We did hit the pocket right here. I'll be viewing it from the 5 seconds now, and price did react on the pocket, which means for me it's invalidated as the pocket has been front run. So you can see right here, I'll mark out the front run, which means FR is the front run, which means that the piece of liquidity is hit, reacted already without hitting my level. So I'll be marking this like this. And what a front run does, it provides a lower probability of reacting the second time, so I always skip those examples. But I'm happy to take this example with me, as it just shows another piece of price and another piece of data that supports my study case around front runs. So in this example, I'll mark out the front run with pocket hit, so it had hit pocket while it reacted and failed afterwards. But if the pocket hasn't hit yet and price comes towards it, but it did react a little bit, it's a higher probability than if the pocket is already hit and the liquidity is already absorbed out of it. So I'll be marking out the 5-second screenshot right here, and I'll be doing a 15-second as we saw the level in the 15 seconds as well as zooming out a bit more to show the overall environment and price right here. So that's another sample collected, and that's essentially how you collect data. Just going over these things, only marking out the things that are important. Do not mark out every single part in price because you don't have to. You just have to focus on the piece of pie of the piece of pie in the market, your piece of the market, the thing that you want to execute on a daily or a weekly basis, even on a minute-like basis. Even for me, as you can see, I had some samples which one was valid and all the others were a bit invalid, just like this one didn't take out this low and swept it. This one was counter trend, this one was front ran, so these three got invalidated, while this one was valid and did not invalidate. So essentially for this first 20 minutes of price action, I saw a lot of price action candles, but I only would have to take one trade according to my plan. And that's to keep it simple and keep it to the best. As I know, there is a not so high frequency in forming great A setup levels, but if they do form, I take advantage of those. So yeah, that's essentially how you do a study case with gathering samples, providing the data. I'll be marking the data on this as well. The front run and the higher time frame pro trend as we were trending down overall, but we failed afterwards. And these are the distinctions I bound to it. And I will be doing this backtesting more for the rest of the session to collect more data and provide even more samples for these two things to create a good batch of samples that it's big enough to be proven that it actually would work to manage my trade under that. So I won't take any guesses that will make me end up in doubt when I have to execute it and it wouldn't work for an anomaly. Let's say an anomaly is a string of trades that does not play out or has a lot of losses in a good win rate strategy. They are inevitable. There are inevitable probabilistic drawdowns that you have to sustain in that matter. You better be prepared as well as being able to trust yourself, your plan, and that different distinction than bitching out or doubting everything. So I really hope you guys enjoyed this. If you want to contact me, you can contact me on Discord, you can join my server, you can check out this script or this Notion template in the description down below, and I appreciate you taking the time to skip through this or check this out. And if you guys have any feedback on this or appreciate the template, or if it's for any help to you, please just let me know. I can always check on what we can do for each other. So wish you guys a great day, and bye bye.